Zoomcast, there we go. Good morning, everybody. Welcome to our continuing Zoomcast session. My name is Robert Crowder, and it's my pleasure to welcome you all here today on behalf of all of us at the Benefits Trust. Today, we're going to talk about a deep dive into group long-term disability. We did two sessions on this exact same presentation last week. We had over 150 advisors on both of those calls, and we're expecting a lot more today. So that's awesome. So thank you very much for coming. For participating today, you are going to receive a CE credit. Mike's going to send that out to you right away. We're also going to send you a very short survey, so please fill that out and send it back to us so you can tell us how we did today and how we can do it better tomorrow. In addition, in that survey, there's a really small box that you can fill out and say future subjects that you'd like to see covered under these Zoomcasts. We've got Zoomcast scheduled throughout the end of the year. We're going to be announcing July and August and September dates very shortly. As well as that, if you're not signed up already, you will be signed up for a Trusted Advisor newsletter. I think we're at 130 months, 130 consecutive months that we've been sending these out. So you're going to get that. And it's interesting. I've been in this business for many, many years, I think probably 35 or 36 years now. And I've attended lots of sessions over those years. And I think if you get one good idea out of this, I think it's fantastic. So it's time well spent. I'd like to introduce some of the staff that are with us today. From the Benefits Trust, Lindsay Gibson is in the house. Mike Ignatz is here. Carrie Lane is with us. My son, Rob Crowder, is here. And our newest staff member, just about 10 days after joining us, is Jordan Volhos is in the house as well. So if you've got questions, please either raise your hand with your little emoji thing, because I can't see everybody on the screen. So please raise your hand or put it in the chat box. Put it in the chat box so everybody can see. And by the way, these folks are going to be able to answer your questions. But in addition to that, if somebody else has an answer that they want to put into a question, please put it in. Because this is a room where it's not about being the smartest person in the room. It's about being in a room where everybody gets smarter. And that's really what the philosophy is. So with that, I'm going to share my screen here if I could, and let's get started. It's exciting. It's exciting to talk about this topic for sure. Long-term disability. So a deep dive into group long-term disability, not individual long-term disability, but group long-term disability. What we want to do is talk about a little bit of a group LTD preamble. I want to talk about taxable benefits and non-taxable benefits, LTD offsets, creative plan designs, non-evidence maximums and your risks, and of course, question answers discussions, and we can have that throughout the session today. So again, please either raise your hand with the emoji so I can see you because it'll pop up on my screen, or put it in the chat box, and everybody's welcome to share in those discussions. And again, it's about being in a room where everybody gets smarter. So with that, a little bit about the Benefits Trust, our 30-second commercial here, if it's going to be that long. But we started on January 1st, 1994, so we've been around 30 years, or just over 30 years. We're a full-service third-party administration company. We believe that we are the largest independently owned TPA in Canada. We provide custom employee benefit solutions. We provide exceptional client experience, and we do that by saying we do the 5% extraordinarily well. For example, what I mean by that is, yes, we pay claims. Yes, we send out bills. Yes, we have an app. We do all of the things that you would expect us to do, but we do the 5% extraordinarily well. And when I say the 5%, I mean the stuff, when there's a question about a bill or a question about a claim or a question about something, we answer the phone. We answer the phone and get to the bottom of it. We're really easy to deal with, and clients tell us that we provide exceptional client service. We've got long-term relationships with all the major insurance carrier and service suppliers, so we're not pigeonholed into with one particular carrier. So we can provide the insurance and supplier solutions that are needed in an employee benefit promise that an employer is making to an employee. Our target market is working with advisors like yourself, professional advisors, with clients primarily from 1 to 100 employees. We do have a lot of cases that are over 100 employees, but again, our focus today and our target market is working with clients like you that have clients with 1 to 100 employees. Why do we do that? Well, quite frankly, there's 450,000 businesses in Ontario, and 440,000 of those have less than 100 full-time employees. This is the market that the majority of us are dealing in. And when you talk about 440,000 prospects, There's endless opportunities out there. There really is endless opportunities. It's not a zero-sum game. If Chris gets a client, Chris Gorey, who's with us today, if he gets a client, it doesn't mean that Dave Patriarch is losing a client. It's not a zero-sum game here, folks. There's 440,000 businesses, all within an hour's drive or click away. So as a result of that, there's a huge amount of opportunity. So let's focus on Group LTD. Group LTD, in the simplest terms, as I like to say, is a life raft. It's a safety net. It's a lifeboat. It's a valuable financial safety net that replaces a portion of your salary if you become injured or ill, right? That's what it is. You might be on one of the nicest ships in the world, one of the nicest cruise ships in the world, and they've got a great dining room and great bars and pools and all entertainment and all those wonderful things, but somewhere on that cruise ship, the first thing you do when you get on the cruise ship is, before you even leave the dock, so to speak, or pier, you go to a muster station and go to the lifeboat drill. Everybody's usually half tanked by that time, but it's there, right? It's there, and what has to happen in an emergency. This is a valuable part and a valued part of any employee benefit program. People don't necessarily, employees and clients and prospects don't necessarily look at it in a lot of detail, but they know it's there. They know it's that safety net if someone becomes ill or injured. So let's take a deep dive. And it was interesting. In November of 2023, we were setting out the schedule for Zoomcasts into 2024. And some of the feedback that we received from you in those short surveys that we asked you to fill out at the beginning is someone, a couple of people suggested we do a deep dive into LTD. And it was interesting because, we said that's a great idea. Let's do a deep dive into LTD. And when I started doing research, I realized how much stuff, after 35 years of being in this business, how much stuff, I didn't know, right? I was literally going over thousands upon thousands of pages of information, or skimming thousands upon thousands of pages of information, to come up with an appropriate angle for this. And one thing that I realized is, first of all, how much stuff I forgot, how much stuff I was reading into. But I decided to take a little bit of a different approach to this. And it's really a deep dive into the questions and the discussions that you should have around LTD. The questions that you need to ask, the discussions that you need to have around LTD, because this is going to help you design what plan is best for them, your client, that prospect. It's about helping them design what's best for them. But if we did a deep dive into LTD, and many of you know this, we could spend 3 days on this. Dave Patriarch through CGIB does these sessions. I think the next one's May 8th or something. But it's a 1-day session, but we could do a 3-day session just on group LTD and LTD and how it works for clients. But anyways, we only have an hour. We don't have 3 days. So we're going to talk about the discussions around LTD. So the question that I have is, who's the plan for? Who's the plan for? Is it for the employer, right? Who's a group LTD plan for? Is it for the employer? Is it for the employees? Is it for the employee's family, right? And it's interesting when, you're thinking about that, the employees' families, well, they might just be a single employee, but they still have family. They might have parents, they might have aunts and uncles, they might have cousins. Who's the plan for, right? What's the plan for? To reduce employer liability, to reduce employee financial stress? What's the plan for? So these are all questions, right? And when we look just at the first couple of slides in this preamble, we're using some pretty powerful words. Portion. What does portion mean? How much of that portion? A portion of something is, well, how much? How much is the portion? And salary. I need all my salary. I spend it all. So I need my salary. And what is salary made up of? Well, a lot of times people think of salary as what they earn. Maybe not just the paycheck, but it's what they earn. And a lot of people have performance-based compensation arrangements in their organization. So when they think of salary, they're thinking of their total earnings. But how is salary defined? Right? Liability. Whose liability? Is it the employee's liability? Is it the employer's liability? Stress. Whose financial stress is it? Is it the employer's stress? Is it the employee's stress? Is it their extended family stress? All of these words in this preamble lead to more and more questions. It just opens up the question vault, as I like to say, leads to more and more questions. So why? Well, let's just break down the risk for a moment. You've got a standard employee benefit program. There might be 10 employees in this organization, or 20 employees in this organization, or 5 employees in this organization. And you've got someone that's got a $3,000 a month long-term disability benefit, and let's assume that person is 30 years old and it's paid to age 65. Well, that liability is $1.26 million, right? So long-term disability and group long-term disability can be a huge risk. When you think about an average payout, an average claim, an average dental claim being, $300, an average life claim being $25,000 in a group plan, one time's earning, maybe it's 50 or 75, right? But all of a sudden you've got long-term disability that could be potentially paying out for 30 years, and an average, and in this case, it's, the present value of $1.26 million. That's a huge liability. It's a huge risk, I should say, compared to that $300 life claim. It's a huge risk. So when we break down that risk, we really have to look at it in a great bit of detail. Group LTD is part of an employee benefit program. It's just part of an employee benefit program. It's part of the promise that the employer is making to the employee. It's part of that promise. And when you're speaking to a client or a prospect, I think it's important, I think it's critical that we use simple language, very, very simple language. And we can't use insurance language. We use too many TLAs in insurance language. Does everybody know what a TLA is? Right? A TLA is a 3-letter acronym. Right? It's just a 3-letter acronym. We use too many. I often have said, and in past presentations, I've said, our job as advisors is really to translate insurance language into English, right? And especially, this is so true when we're thinking about long-term disability. Things just in simple things, in the research that I've done, right? Long-term disabilities, you talk about NEMs, we talk about offsets, we talk about taxability, we talk about COLA. We're not talking about something you mix with rum or Jack Daniels, right? We're talking about own occupation definitions, any occupation definitions, residual, partial, occupation class, waiver, reoccurrent, rehabilitation. You're talking about all these things. And the employer's eyes are glazing over. They don't understand this. Now, I did something interesting just this morning on this. I figure an average employer that polishes widgets, that has 10 employees in their organization or 15 employees in their organization, right? And all of us have those clients, right? They spend maybe an hour a year thinking about benefits. You and I spend a lot more time thinking about benefits because this is our business, or a part of our business, right? For us, it's 100% of our business, but we spend a lot of time thinking about it. But the average employer, that has 10 employees, they maybe spend an hour a year thinking about this. And they think about their whole employee benefit program. An hour a year. Well, hold on a second. The average person is awake for 5,800 hours a year. You get 1 hour, maybe. You get that 1 hour. And again, that might be spread out over a year. But the employers do not spend a lot of time thinking about you. They don't spend a lot of time thinking about their employee benefit program. They're awake for 5,800 hours a year, and they spend, a very little bit of time thinking about their employee benefit program. So it's important that we use that time extraordinarily well, and especially thinking about long-term disability, because it's a huge risk within an employee benefit program. So we need to speak English. So again, some common language that we might want to use, and it's all in the form of questions. Do you want your employee's paycheck to continue if they can't come to work? Simple language, simple question. Do you want your Mr. Prospect, Mrs. Prospect, Mr. Client, Mrs. Client, do you want your employees to paycheck to continue if they can't come to work? How much of the paycheck do you want to have? How much of the paycheck do you want them to have? There's got to be a motivation for them to get better. You can't have 100%, or you can't have 150% of their paycheck. How much of the paycheck do you want them to have? Right? How long do you want that paycheck to continue? Hey, we all know we use that analogy at the top of the presentation today. It's a safety net. It's a life buoy. It's a life ring. Yeah, it's not going to be as comfortable as the cruise ship you're on, but it's a safety net. How long do you want that safety net to last? Do you want that to increase with inflation? Do you want that paycheck to increase with inflation? If you have a $2,500 benefit right now, that $2,500 is not going to be worth as much in 10 years from now. Look what's happened with inflation and food prices over the last 3 years. It's unbelievable. Look at what's happened since yesterday at 4:30 when the budget came down, right? The Liberals, I'm not going to get political, but the Liberals have a spending problem, not a saving problem. Anyways, when do you want to stop paying the employee? After a month? After a year? Somewhere in between? Simple language that the client can understand. Do you want this payment to be taxable or do you want this payment to be tax-free? These are questions that you're taking and asking in simple language that an employer, a prospect that spends 1 hour a year thinking about this stuff can answer. You think about their thinking and what they're going through, as opposed to, hey, we can set up a long-term disability program that has got an NEM of this, and it's a taxable benefit, and it's an NEOC for 2 years and ONOC after that. Great. They're going to go, I don't even know what that means. So you ask questions like this, what happens if your employee, paycheck, how long do you want your employees to have their paycheck continue for? The other thing I've noticed is in dealing with smaller employers, the majority of my career, smaller employers know everybody's business. There's two types of employers. There's employers where everybody knows the HR person. Everybody knows the HR person. So we have a person in our office at the Benefits Trust, and we've got 30 employees. Everybody knows Britt. Everybody knows Britt, right? And so that's one type of employer where everybody knows the HR manager. The opposite is true as well, where you've got an HR manager that very few people know. So an example of that is my wife, Michelle. She used to work at the Royal Bank, and she came home one day and she had a piece of paper in her hand and she goes, "What does this mean?" And I read it and I said, "You just got a reduction in your benefits." And she goes, "Oh." I said, "What are you going to do about it?" And she goes, "Well, I'm going to do absolutely nothing. What am I going to do? To go down to King Street and knock on the, vice president of HR's door and have a discussion with them?" No, she's not going to do that. So there's two types of employers. One where everybody knows everybody's business, and one where nobody knows anybody's business. So when we're talking about these smaller employers, everybody knows family members, everybody knows about marriages and divorces when they happen, when people are sick, when they've got celebrations coming up, and they know what happens when somebody goes on disability. They know what happens when somebody goes on disability. It's not just a number, right? All of a sudden, everybody is concerned for that particular individual and how they're going to fare. But all of a sudden that shifts a bit and they go, "That's too bad about Larry. That's too bad about Mary," right? "I hope Mary or Larry get better soon, and I hope they get the help that they need for whatever ailment they're going through." But hold on a second. It quickly changes to, who's going to pick up the work? I'm already busy. I have a life. Who's going to pick up Mary or Larry's work? And how long am I going to have to do that? Is it going to be a week? Is it going to be a month? Is it going to be a year? When is the employer going to hire somebody new? Oh my gosh. So all of a sudden, things are a little bit different in smaller employers. Their philosophies are different. What happens if one of your employees can't come to work tomorrow because they're sick or injured? Great question to ask. What happens if one of your employees can't come to work because they're sick or injured? What happens if this is one of your key employees? Like one of your absolutely key employees. Like, for example, you got a smaller employer, everybody's got a key role, but there are some that have a really key role. What if it's your top salesperson? What if it's your CFO or the person that's doing that CFO job? What happens if it's one of your key employees, right? How long do you want to continue to pay them if their productivity is zero? How long do you want to continue to pay them if your productivity is zero? These are all great questions. These are all great questions to ask your clients and prospects when we're talking about long-term disability. So long-term disability, when you're talking to a profitable small business, they often think very differently than large public companies, or even large private companies for that matter, but they think differently. And LTD plans should reflect this philosophy, and you get this philosophy out of them, out of your clients and out of your prospects by asking questions. Questions like we've just discussed, right? And their philosophy can vary from very vastly from company to company. So it's important to ask and understand your client's philosophy. It's really important to understand this philosophy so you can help them design an LTD program that works best for them. How do you feel if? How will your other employees feel when? You know, what is your community going to think? This is something that's important as well. Great question. What is your community going to think? Everybody's got a community. So for example, you know, I'm in your community, you're in my community. I'm not talking about physically or geographically. I'm talking about, you know, everybody knows that we're in the benefits business. We're a full service third-party administrator, right? All of a sudden, one of our employees goes off sick or injured or disabled for whatever reason. And it gets through the community, quote unquote, that we don't take care of them nor we care. And we don't have any long-term disability and we just shove them out to the curb and say, good luck. Well, how's that going to work, right? People are going to go, yeah, they might have an interesting product, but they treat their employees like crap. So I don't want to align myself with them, right? How's your community going to feel, right? So these are all great questions to get the employer's philosophy out of long-term disability. So there's my preamble, 20 minutes. Now let's talk about taxable benefits and non-taxable benefits. Well, which is better? Which is better? Anyone care to chime in? Not getting into too much detail?
Taxable.
Michael?
Non-taxable benefits.
Non-taxable benefits. Anybody want to say taxable?
The one that fits the client's needs and sharing and everything.
There you go. There you go. There's a good one. Thanks, Dave. Jumping in. I appreciate it. Thanks, Michael. Well, it's interesting. I talked to two industry experts. Both have 40 plus years in this business. They often lead with the LTD card as experts, and they know more about LTD than I ever will, without a doubt. And I talked to them when I was doing the research for this, and I set up an appointment with these folks, and you know, set up a 20-minute meeting, and we went through what their philosophies are with respect to group LTD and so on. And one of them said taxable is the best way to do it, and the other one said non-taxable is the best way to do it. And it was interesting because they're two industry experts, and they both had different, you know, opposing views, which is great, you know, which is super. So what's the difference between taxable and non-taxable? Well, taxable group LTD benefits means the employer pays some or all of the premium for the long-term disability plan. Simple as that. The employer pays some or all of the premium for the long-term disability plan. Even if they pay $1 of the premium, it becomes a taxable benefit. That means if someone's receiving, for example, $5,000 a month in benefit, that's just considered taxable income, and they will have to pay tax on that benefit, and they will result in probably about $3,500 a month after tax. As well as that, the employee that's receiving this taxable income can make RRSP deposits. Okay, so taxable group LTD is if the employer pays some or all of the premium for LTD. Couple of things to consider: some or all. Okay, so let me ask a question. Let's just say it's a contributory plan, and the plan is contributory to the tune of 50%. The employer has a policy that says, hey, great, 50% of the premium is going to be paid by the employer, and 50% of the premium is going to be paid by the employee. So what we do is we take the the total premium line off the billing statement, the insurer or the TPA's billing statement, and let's just say that total bill for that particular individual is $100 in this particular month. So the employee pays $50 and the employee pays $50, right? Simple. That's straightforward. Got it. And then what the employer says is we are going to have a non-taxable benefit, which we'll get to in a moment, because 50% of that premium will cover the cost of the long-term disability. Or does it? Well, hold on a second here. You might have a highly compensated individual that's single. So you've got a highly compensated person that's single, and their long-term disability benefit premium might be more than 50% of the overall premium because they've got single health, they've got single dental, or they've waived their health for whatever reason. Whatever the situation is, doesn't matter. But they've got this this premium, and it doesn't cover all of the premium. So therefore, geez, is their LTD benefit taxable because the employer is paying part of the premium, or is the whole company's LTD offside? And what it is the whole company's LTD benefit is offside. Therefore, the benefit becomes taxable. So it's really important to understand that, right? If they pay just a tiny bit of it. Or I remember running into this one employer and they had a contributory plan and they had a non-taxable benefit. But what they said is in December, what they often do in the month of December is they give their employees a premium holiday. They say, hey, great, instead of withdrawing this from your paycheck this month, as a Christmas bonus, we're going to pay for your group insurance. Well, that just throws everything offside. They were doing it out of good, with their intentions were good, but as a result of this, it created some problems. So this is where the questions come in and the education comes in that you provide. So taxable group benefits, if the employer pays some or all of the premium and the employee's benefits are received as taxable income in the hands of the employees. Simple as that. Non-taxable group LTDs is where the employee pays 100% of the premium for their plan. And as a result of that, any benefits that they will receive from this benefit will be received tax-free. So if they have a $5,000 benefit, they would receive that $5,000 without having to pay tax on it. It's a tax-free benefit. But as a result of that, they will no longer be able to make RRSP contributions because it's not income. It's not earned income. So the employee pays 100% of the premium. Now, what happens? And they have to do that on every single paycheck. On every single paycheck. So what happens is, through the discussions of the last two sessions that we've run, is some people go, well, hold on a second. What if we just, increase the employee's salary to cover the cost of this? So it looks like they're paying for it, but they're not actually paying for it. Absolutely, you can do that, but you've got to do it every single pay. Every single pay. You just can't do it at the end of the year. You've got to do the deduction on every single pay, right? So it's important that if they're going to have a non-taxable benefit, it's got to be done right, and it's got to be done on every single pay. Does anybody have anything to add on this or horror stories that come up? Rob, thanks for joining us. Please share.
Just a quick question, Rob.
Yes, sir.
So what you're saying there, and I know this is an ongoing debate, and Dave P will probably chime in at one point. So if the employer pays the LTD premium and then puts it on the T4 at the end of the year in whatever box 85, other income or whatever, wherever it fits, is that onside or offside? I always just suggest that if you want it non-taxable, have the employee pay every deduction, every pay. But I know some people say that you can do that with the T4 at the end of the year. And there's Dave P as suggested.
Great question, Rob. And this has come up in all three sessions. So thank you very much for bringing it up. Dave, do you want to take a shot at this?
Sure. So CRA is really clear. You can have the employer pay the premium, show it as a regular taxable benefit throughout the year on the pay stubs, weekly, biweekly, monthly, whatever it is. That will then show up on the T4s and would be deemed non-taxable at time of claim. But like Rob said, only if you are showing it as a taxable benefit, just like life insurance, AD&D, dependent life, same kind of thing. You show that regularly all the way through the year. Then even though it's employer paid, it can be tax-free at time of claim. And
but
for
it's
the
going to be
reference,
done on a regular basis, correct, David?
Yeah, yep, correct. And the reference is IT 428, Section 17, Part 2. If you're looking it up.
You come to these sessions to get educated. Great. Okay, Rob, real quick. Thanks, Dave.
Yeah, I just want to make sure I understand you, Dave. So as long as you show it as a deduction on the pay, even though the employer's paying it,
not a deduction,
a taxable benefit.
You're showing it as a taxable benefit. So
yes,
it's adding to the pay. So in essence, the employee is just paying the tax on the premium, not the full premium.
And that's on side.
That's on side. I'll post the link in the chat here in a second.
Okay, thank you.
Thanks, Dave. Great conversation. So thank you all very much. So we're clear on what taxable and non-taxable benefit. Well, it's clear as mud. And so what's better, taxable or non-taxable? What is better, cheese or cheddar or mozzarella, right? Red wine or white wine? White wine, blah, blah. Maybe I've had too much wine this morning. That's why I can't speak. Steak or fish, skiing or snowboarding, power boating or sailing. What's better? I had to throw that one in for you, Dave, right? But the answer is it depends, cheese or mozzarella or cheddar or mozzarella. They're both great cheeses. It depends on what you're doing, right? Red wine and white wine. It depends on what your time of the day it is. And you're not going to have a big full-bodied Amarone at 10 o'clock in the morning, or maybe you are. I don't know. But it depends on what it is that you're doing. Both can be great choices. It just really depends. So some kind of considerations for a taxable benefit. You know what? The employee just pays for everything, right? Communication is easy for the employee. Great. We've got this benefit. We're paying the premium for it. It's a taxable benefit. You can make RSP contributions. Have a great day. There's no employee pushback due to payroll deduction, right? Canadians live paycheck to paycheck. Average Canadians, or more above average, the majority of Canadians live paycheck to paycheck. So all of a sudden you're withdrawing 50 or 75 or $100 a month off their paycheck. They're starting to say, hey, I can't afford that. I need that money. That money is going to make a difference in me paying my mortgage payments, right? So there's no employee pushback when the employer says, hey, great, we're just going to have a taxable benefit. We don't want any hassles. We don't want it to go offside. We're just deeming it as taxable, right? So those are considerations for the employer. Considerations for the employer when they're talking about a non-taxable benefit is communication could be a little bit more difficult. And you get potential employee pushback and dissatisfaction. Plus, they can't make RSP deposits. But again, Canadians are living paycheck to paycheck, right? So this is where a lot of employers are getting pushback. They're saying, I can't afford this benefit. Can I opt out? Because again, everybody knows Brittany. Everybody knows the HR person. So they're going to the HR person that might be wearing this hat 1 hour a week, and they're giving them the sob story, and the sob stories are real. And I hate to use the word sob story, but you know what I mean? They're getting pushback and they're saying, I can't afford it. I don't want this. I'm never going to become disabled. I don't want this benefit. I need the money, right? So it becomes an interesting dynamic when an employer is designing a plan that works best for them. These considerations have to be taken into play, right? Into play. And especially when you look at the demographics of a group, if you've got a group of, for example, 10 lawyers, and they're all making $200,000 a year or more, right? You can have a very different discussion than if you've got a group of, let's call it daycare workers, where they're all making $35,000 a year. Well, they both need long-term disability, but who's the best pay for it? Who's the best to pay for that benefit? And these are considerations to take into play when you're looking at taxable or non-taxable. You've got to point this out to the decision maker so they can make an appropriate decision, right? I don't want that payroll deduction. It's too expensive. I'm never going to be disabled. Things that we've just talked about. Again, paycheck to paycheck. As simple as that. Paycheck to paycheck. So let's talk.
Rob, sorry, I got a quick question for you there. Related to that taxability, and I think we've kind of touched on it. Why would you actually have a taxable plan whatsoever? It shouldn't really even exist, because based on what you've said, as if the employer is going to pay it, why wouldn't they just make it a taxable benefit?
Well, that's what we're talking. Well, yeah, that's what a lot of employers are doing. They're just saying we just want to have a taxable long-term disability benefit. We're going to pay 100% of the premium, etc.
Well,
no,
it shouldn't be.
But then you can still do your RSP. If you're showing it non-taxable, then you can't. That's the plus.
Sorry. Okay, gotcha. There's a side section to that. Is it still counted as income? Okay.
It's still counted as income as opposed to an insurance contract benefit.
And if I can say, sorry, Rob, to interject, but most people are not making the decision on best income or best RSP contributions. They're just trying to do cost sharing. In Canada, about 51% of all plans are non-taxable. And that's not because they've done some great math. They're just trying to have something that's cost sharing with the employees that is income based, so it's fair, right? So somebody's a minimum wage employee, their deductions and cost sharing is going to be really low. Somebody's really high income, they're going to be higher. So it's kind of less prejudicial. I'm
Yeah.
like, I don't know, like it just kind of fits. So yeah.
It's kind of the worst benefit to do any cost sharing on, though, because of all the complexities of it. Like if you're gonna do cost share, do it on any other benefit, do it on health and dental, just don't do it on the LTD.
Yeah, and Rob said it right, but like if you really get into the CRA rulings, if you had somebody who had a split premium share, partly by the employer, partly by the employee, then CRA actually has a ruling of how it could be all split up proportionally, and it goes through this big long formula. But most insurance companies can't handle it. So the easy answer is straight taxable. And that's a problem. So although we kind of tend to live within the simplistic, it's because the insurers behind all, insurers direct or behind TPAs, they're actually insuring the LTD, their systems can't handle it. So it's make it simple, pick rule 1, 2, or 3, stick with it. And rule 3, you still have to educate the insurers sometimes.
Yeah, a lot of it, like I said, we were awake for 5,800 hours and we spend maybe an hour on this. The employer spends maybe an hour of this on a year. So you want to give them options to make it make it simple. Anyways, group LTD offsets, moving along. Almost all group LTD policies allow the insurer to deduct other benefits from the amount that they're gonna have. So, generally speaking, you see something like an 85% all source maximum in any standard policy. That means, hey, if somebody's getting paid from other places when they go off on disability, the most they can make is 85% of their pre-disability income. So somebody can't have 150% disability. They've got no incentive to go back to work, right? So the insurance company obviously wants the employee to get off claim and go back to work. Some of these offsets can include things like the Canada Pension Plan disability payment that somebody might be receiving, or workers' comp payments from a motor vehicle accident. But using these examples, you can't stack to get over that 85. You can't stack payments to get over that 85% all source maximum rule. Simple as that. So, looking at the other end of that, the zero. What is zero sum offset? Oh, I just noticed that third time we've done that. What is a zero sum offset? Apologies. Hey, we're not perfect. But claimants, so it's interesting. A claimant can be approved for long-term disability, but their payout might be actually zero. So they can be approved for long-term disability, but the amount that they're going to get is nothing. Well, here's an example. Let's just say the employee is going to get $2,500 a month that they've been approved for. Well, fantastic. But then they realize, the insurance company realizes and the employee realizes that they've got a workers' compensation benefit because they were injured or hurt at work. And they've got a workers' compensation benefit of $1,800 a month. And then because they're totally disabled in the eyes of the Canada Pension Plan disability section of the Act, they're going to get $800 a month from the CCPD. Well, great. That totals $2,600 a month. But meanwhile, their benefit is $2,500 a month. Well, that's more than 100%. So therefore, they're going to pay the payout from the long-term disability is going to be actually zero. So all of a sudden, they go through this whole rigmarole about claiming and so on and getting approved, and then they get nothing out of it. So you get a lot of questions out of that, or they get a very small portion of it. Using a different example, they might only get $500, right? But they've got a $2,500 benefit because they're getting paid from other places. All of a sudden, it becomes the question: why am I paying for this benefit? Again, the employer looks at this because everybody knows everybody's business. And the small employers, the employer looks at it and goes, this is bullshit. I'm only getting $500. And then you have to take the time to explain to them. And they're going, why am I paying for this coverage? Another question comes up, using this example, with the zero sum offset, should the employee still apply for long-term disability? And the answer is 100% yes. 100% yes. Because the WCB payment may stop at some point in the future. CCPD may say that you are no longer disabled, right? The motor vehicle accident payment may stop, right? So you definitely have to apply. The other thing is you do not wait to apply till the end of these payments. You have to apply within 90 days of the disability. Right. In most contracts, they need to be aware of the claim within 90 days. Right. So it's important to apply for long-term disability insurance right out of the gate. As simple as that, even if the amount is going to be very little or zero. So let's talk about question. James R. Taylor.
How are you? Just one of the things
Quick.
one of the things, hopefully you can hear me okay, because I'm driving, unfortunately. But sometimes WCB doesn't want to continue a claim in the sense of paying income. They buy it out. They
Yep.
buy out that claim and give a lump sum. So how is that going to integrate into the long-term disability claim now that you're not getting a continual income? Maybe Dave can help with that as well.
Yeah. Any thoughts on that real quick? Anybody? Dave?
It kind of depends on how it's paid out. If they're doing lump sum, then the insurance company will quite often be involved. And this could be the same as if there's a lump sum severance payment, like if the employer has decided to sever the disabled employee. So they'll work it out and kind of go, okay, hold on a minute. This may or may not be allowed, and how that severance or that lump sum is paid can change all over the place. But generally, if I can make a rash generalization, which don't hold me to it, they would reduce the income because you're getting income from this other source. So again, you're not going to double up, but it's not that simple. It tends to get a little bit messy.
And
And-
I was going
No,
to
I
say,
was just going to say, you're right, like WSIB or WCB or WorkSafe, depending on what province you're in, there's lots of cases where it does stop prematurely, and because it's maybe deemed a non-WCB case, non-workplace injury, and it's straight into the LTD, which, like Rob said, if you haven't done it, you're in trouble.
so it's really, James, in answer to the question, it depends on a number of factors. It's done on a case-by-case basis. There isn't any white sweep, and it depends on what the contract says as well. Creative plan.
Yeah, and that's what I actually have experienced. But I just was asking the question with some already knowledge on that, but just was thinking others' experiences would be helpful. But that's good. Thank you.
Great question. Thanks. And be careful driving and listening, and don't watch, listen. Without a doubt, because we don't want you to go on long-term disability. Creative plan.
Rob, sorry to cut you off. I can't put my hand up. It's
Yeah.
Corey speaking. Anyways, I wanted to share a long-term disability, what would happen with a client with mine. So they were on WCB. They ended up having an additional surgery and wasn't able to continue on with the rehabilitation plan with WCB.
Yep.
So then WCB actually cut them off. So that's where the LTD kicked in and supported that employee.
Yep. And another reason why to apply. Thanks, Corey. And great comment. Another reason to apply for long-term disability as soon as you can. Creative plan designs, just waiting periods. Play with waiting periods. It's kind of interesting because a lot of insurance companies will accommodate these types of things, but whether it's, and let's not get into 121, 124, it's 90, 105, 120, 183, 365. You can set your waiting period wherever it is that the employer can set it wherever it is that they want, but the longer you wait, the less risk, and therefore smaller the premium. You can have I dealt with one company in my history that they had a very effectively managed short-term disability program where they had early intervention, right? And they wanted their long-term disability to start after 2 years, right? And it can be very effective. Their premiums for their long-term disability were low, but one of the things that was critical is we had to get an extension on when they start claiming for long-term disability. So it has to be done within 90 days. We got it moved out to 6 months, right? So, and we also had the manager that was involved in the short-term disability program, the outside manager that was involved in the short-term disability program that was also involved with the long-term disability carrier, right? James, do you have your hand up, or are you just forgot to put it down? There we go. Thank you very much. Another creative plan design, and I just want to touch on these with the little time we have left. It's interesting. I was talking to an employer about this and about their philosophy with respect to long-term disability. And they go, hey, the most I want to pay is 5 years for this class of employees. You know what? An employee can come in and give me no notice, and they can, give me 2 weeks notice and they can leave. I don't, and they're going to have 5 different jobs in their career, or 6 different jobs in their career. They're only going to give me 5 years. I'm only going to limit my long-term disability payout for 5 years. That's my philosophy. That's what it is. Right or wrong. And it's not right or wrong. I shouldn't say right or wrong. It's what their philosophy is. It's what their benefit is. And again, it reduces the long-term disability costs a bit because the risk is different because it's only for 5 years. Another thing, own occupation to age 65. More expensive, but a terrific way to attract and retain professional and executive staff. You can have this for a class of people, right? You've got an engineering company. Fantastic. You want to own occupation definition to age 65. You got a law firm, you know, a group of doctors, whatever it is. Own occupation to age 65 can be very important and can be very attractive benefits, especially again, in retaining and attracting these types of staff. Premiums go up. Another creative plan design continued. This is a specialty product from Lloyd's of London, but it says, great, own occupation for 2 years, any occupation for the next 3 years. If you're still on long-term disability, the present value of the remaining benefit is paid out in lump sum. It's just done. There's no discussion. You're just paid out. So ideally, you want to be on benefit for, 5 years plus a day. Because after that 5th year, if you're still, the first day of that 5th year, you're still disabled, you get a lump sum payout. Great. Even if you can go to work a year later, a week later, a day later, doesn't matter. But again, another specialty product that's out there, it's like it's called an accident and serious illness disability policy, right? And this is great for high risk industries, roofers, hotel workers, etc. It's a terrific benefit for high risk industries. It's like a CI and AD&D policy combined that pays a monthly benefit, right? When you get diagnosed with an Alzheimer's disease, blindness, cancer, heart attack, loss of limbs, Parkinson's, etc. What it doesn't cover you for is mental illness related claims, right? So the premiums are significantly less than what the premiums are in a traditional long-term disability group long-term disability policy. But again, this ACID program, as I call it, or the ASID program, it's not necessarily a traditional LTD program, but it is similar in many ways. And it's great for higher risk industries, right? NEMs, and I've got Dave Patriarch's CGIB insurance checklist up here, and we're going to talk to Dave in just a moment about this. But small clients, let's say you've got a small client. Again, they've got 15 employees. Right, and their maximum benefit on their long-term disability program is $5,000. Their NEM, not evidence maximum, is, we're using all these TLAs, but we all know them. Their not evidence maximum is $2,500 a month. Well, great, $45,000 times 66 2/3 equals $30,000. Divided by 12 equals $2,500 a month. So anybody making more than $45,000 has to fill out an evidence of insurability form to get that amount above the $2,500. Fantastic. So you need to provide that medical evidence for anybody making over that $45,000 a year. Every year, every raise, right? Advisor and the plan administrator has to stay on top of this. What if my pay goes from $45,000 to $45,100 because I had a raise? $100. How much is that going to mean on a monthly benefit? Well, it's going to be in pennies. But hold on a second. I'm promised 45, I promised 2/3 of my income. So how often do I have to do this? Dave, and maybe you can pipe in here, but you do an advisor / employer checklist, and you run this session once a year in Toronto, once a year in other cities across the country.
Yep.
And that checklist includes this item.
Yeah, it's probably the biggest area that gets missed that creates liability for employers. Either people are left off the plan, which is problem number one, or people are left at the NEM. And like Rob said earlier, kind of putting those numbers together as to, that $1.26 million number. If this person was really eligible for $5,000 a month, but, got the 2,500 NEM and nobody chases after it, nobody gets it either to an approval or a decline, then the employer is 100% responsible. They become the insurance company and they would have to write that big check. So just the $1 million check. Yeah.
Because the employer looks at the booklet and goes, oh, $5,000 and puts it down. So what this checklist does is it transfers the liability or transfers the liability from the advisor, you, to the client and makes them aware of this. And then they can decide when it's appropriate to send out the forms. Now, if they send out the forms and the employee doesn't do it, well, that's their business, right?
No, it's not. The courts have said that's still the employer's fault. They have to force them to do the forms, send them home. It does not resolve. It does not absolve the employer of the liability. Sorry,
Awesome.
Rob.
Yep. Thank you. Thank you, Dave. This is what this is for. This is what this forum is for. So awesome. Set expectations in advance with the claims process, right? Set expectations in advance of the claims process with the employers, with the members. You know, all the insurance companies have these 1-800 numbers, which are fantastic. You know, 1-800 help me, limited feedback, right? They're going to ask for more and more reports. They're going to ask for doctors' reports and specialist reports. They're going to be waiting in line to get in to see specialists. They're going to be, you know, talking about rehab and they're going to get confused. It's difficult. And why did I pay for this for years? All I'm getting is questions. I'm not getting any answers. I'm not getting my money. It's confusing. We need to set expectations in advance. And it's interesting, at the Benefits Trust, we have an LTD claim specialist. And she's not a claim specialist. What she is a relationship manager specialist for people with long-term disability claims. She just walks them through the process saying, this is what's going to happen. And this is why you have to be attentive on this stuff. And this is why, is there someone that can advocate for you? Right. And it's just that smiling, caring patient at a time of need. But it's something that's important. You've got to set expectations in advance with the claims process, because it can be intimidating and overwhelming for someone, especially if they're disabled, right? And especially if it's a mental health disability. So it's important to set those expectations, especially with your clients. So, you know, when their employee comes back and complains to them that this benefit is crap, right? They understand what the expectations are. Other considerations. Well, you know what? Pricing can be expensive, right? Without a doubt. And long-term disability pricing can be expensive, and clients don't understand it. They don't understand it. So I think it's important to focus on the plan design as opposed to the premium for it, right? Non-taxable, I don't want it. Tough to explain it's tough to explain the value to employees. I'm never going to become disabled. It's tough to explain the value to employees. Legal sharks are circling. Oh my gosh, you cannot drive in Toronto without seeing a diamond and diamond advertisement on a bus. They often know little about the long-term disability, but they know there's a huge risk and they can make money from it, right? You cannot watch TV. You can't watch a hockey game or a baseball game without seeing the advertisements for these law firms. Why? Because they can make money at it. Why? Because it's such a big risk, right? It's often discriminatory against high wage earners. Long-term disability is often discriminatory against high wage earners, because you got a high wage earner, you're making $200,000 a year and you got a $2,500 max on your benefit. It's great for someone making 45, but it's not good for someone making $200,000 a year. You know, the 2-year ONOC and NEOC clause can be confusing. And, you know, you hear the terms, you know, educated and trained for, but really? You know, you're educated and trained for, what does that mean? And especially at a time when someone's going on long-term disability, and then after 2 years, all of a sudden, you know, they're going to that NEOC definition. Pre-existing condition clause, things you need to be aware of and manage expectations with your clients. Definition of earnings. Well, does that include commissions? Does that include bonuses? I make $100,000 a year. I might only have a $50,000 salary, but I get a bonus and I get commissions. So I'm thinking I get based on the whole thing, but what is it really? You know, what else? Well, there's lots. This is the huge risk in an employee benefit plan. That's why we have to use that simple language that we talked about. The reality is 1 in 3 people are going to be disabled for longer than 90 days before the age of 65. Does anybody know anybody that has been disabled for more than 90 days before the age of 65? Yeah, everybody. And I'm not talking about in your professional life. I'm talking about in your personal life. You know, absolutely. When a disability lasts longer than 90 days, chances are it's going to last somewhere between 2 and 3 years, right? 48% of Canadians are not financially prepared to be off work. We live paycheck to paycheck. 48% of Canadians are not financially prepared to be off work, right? 31% said partners or spouse had to get another job to make ends meet. So fantastic. You're disabled. Now your partner, your spouse have to go out and get a second job. So all of a sudden their 40-hour work week maybe is changing to 60 or 70 or 80 to make ends meet. So you're sitting there by yourself, disabled, trying to rehabilitate, and you never see your partner or spouse. So there's none of that emotional consideration happening, none of that emotional healing. 50% of Canadians do not have any kind of disability income protection. This is important that we talk about this. This is important that we talk about this with our clients. Important we talk about it with our prospects. It's important we talk about it in our industry. So what's next? Well, a huge opportunity exists. Huge opportunity exists. You know, we've got an opportunity to add value. That's really what it is. We've got an opportunity as professional advisors to add value to our clients, to separate ourselves from the people that aren't on this call, that are going, can I save you some money? Talk to our clients, you know, talk to your clients and prospects about group long-term disability. Talk to them in a language that they understand. Ask future-based questions. What happens if this person can't come to work tomorrow? They're key in your organization. How long are you going to continue to pay them if their productivity is zero? Play the discrimination card. Huge opportunity. Sell individual long-term disability policies to the high income earners. If you're not good at that, partner with somebody that is, right? Focus on plan design, not the price. Speak English, not insurance. Speak English, not insurance, right? So in summary, we've got just a few moments left, but we just scratched the surface on this. Don't fake it. You're going to get yourself in a lot of trouble. Don't fake it. There's huge liability if this goes wrong. Manage expectations, right? Stay in your lane, as a friend of mine, Graham Leishman, always says, stay in your lane, know what you're selling, right? And if you don't know what you're selling, either educate yourself to know what you're selling or partner with somebody that can teach you. Speak in terms that clients and employees understand. Employees as well. Take this opportunity to introduce yourself to the employees and explain long-term disability and some of the reality behind it and why they're paying for it or why they have this benefit. Manage expectations around long-term disability. Manage expectations, especially at times of claim, right? Strive for stable premiums over the long term. The lowest price is not always the best solution. The lowest price is, in my opinion, never the best solution. So you want those stable premiums and work with a carrier that can help you with that. So we got a few minutes left. Questions, ideas, discussions. But real quick, starting in May 14th, May 16th, and May 28th, we're doing a deep dive into short-term disability and group critical illness. So make sure you join us there. But again, questions, ideas, discussions. We got a few minutes, and let me stop sharing so I can see many of you or all of you. Am I crazy? Am I offside? Am I making any sense? Who's got some ideas, thoughts, questions? Anybody? Chris, you're always willing to jump in. I'm going to call on you.
You covered it all. Actually, I'll add one thing if you want, Rob.
Please.
It's interesting looking at some group LT quotes for a 100 life case the other day, and looking at the summary. RBCs now including for your for your offset, looking at CPP and what have you for your 85% all source. RBCs now looking at primary and family sources for your offset for your 85% all source maximum. So
I thought that was illegal.
And
they
family.
actually,
I thought that was withdrawn across the nation. Every single insurance company had to do that. Is that just recent?
RBC's it's in a quote right now, Dave.
And family. So what does that mean? Also,
it means the disability benefit going to your kids now goes towards you and gets offset, which I thought Canada Pension Plan said that's offside, and everybody changed it. I would go back and highlight that one to RBC and ask if they actually know what the hell they're doing, because that's weird.
I was taken aback by it. I was going through going through the summary with the client, and they're like, "What is this?" I'm like quickly looking it up. Yeah, and it does point to all sources of income for the individual and their family, attributing being factored into the 85% all source max. So I'll check on that.
So it's important to the devil's in the point here, Chris, and thank you very much for sharing. The point is the devil's in the detail. Take the time. If a client buys a long-term disability policy, right? The devil's in the detail. And it's important that you understand it and can explain it easily to the client so they can make informed decisions. James, we're going to come right to you in just a second here, but I want to thank everybody for coming. We're going to stick around for a few minutes and continue this conversation, but we spent an hour together. You're going to get a CE credit. Mike's going to send those out PDQ. You're going to get signed up for our newsletter as well. You're going to get a real short survey, fill it out, send it back, tell us how we did today. Want to thank you very much on behalf of all of us from the Benefits Trust, including Mike and including Carrie and including Rob, Lindsay, and Jordan. We want to thank you for taking the time to spend with us today, and we look forward to seeing you in future. We're open for business. Visit us at thebenefitstrust.com. We have some 2024 inventory on the shelves, and we're stocking up for 2025 already. So make sure you reach out to us. We'd love to do business with you. If we're not, and if we are doing business together, we'd love to do more. So again, thank you all very much for your time. We can stop recording and stick